Welcome everyone. Today I have a special guest, Dave Seymour. Fascinating story, firefighter to now investor in real estate. And I think we'll all be able to relate to him as he talks about his journey. And we also will talk about, in this tough market, how we can best use our money to make some sound investment choices. Dave, how you doing?
I'm well, brother. I'm well. How are you?
Good. Are you based out of California, or where do you live?
No. So I'm in Boston. Your cousin from Boston. Yeah, I'm in the Boston. I live in just north of Boston, what we call the North Shore.
But so, that accent, is it a Bostonian accent, or what is?
It's a mutt, my brother. It's a mutt. I'm an immigrant to the United States. Don't tell anybody, but I'm actually from London, England. Immigrated back in 1986. So get on the phone with my old man, mate. I start talking like that, you won't understand a word I'm saying. You know what I mean?
That's great. Awesome. So what is your journey? You have a fascinating story, and I don't want to tell it, so I'll let you tell it.
Yeah. And, I could tell this story a number of different ways, but let's see if we can be succinct today. Not usually one of my fortes is to use three words when I can use 3 million. But like I said, I'm an immigrant from England. I came to the States in 86. I was a young gun in my early 20s. Following a pretty similar journey, I would say, that most people follow, the education, get a job, et cetera, et cetera. And it was funny. Financial education, financial intelligence is a rarity. We follow a plan. A lot of folks do, that trading your time for somebody else's money is the only way to go, right?
So wrong.
Yeah. And, you end up paying a price for that one way or another. And I paid heavily for it. I was really good at spending more money than I earned. They kept on giving me credit cards when I shouldn't have had them. They kept on telling me that refinancing my primary residence was the best thing to do. Yeah. And during that time, I had a really great job. I enjoyed being a firefighter and a paramedic. And, but I was a financial donkey. And I say that with respect to anybody who's been down this journey. And I turned around at, my mid 30s, and my house was in pre-foreclosure. I was trading 120 hours, Tom, every week for somebody else's money because in America, look, brother, what do we do here? If I'm not making ends meet, I go get another job.
Yeah, exactly.
Right? And then if you're not making ends meet after 2 full-time jobs,
third one. Yeah.
It's third one. America's great. You can work until you die, right? And you pay a price. You pay a price for that. Cost me a marriage. Almost cost me a relationship with my now oldest boy, 27. Yeah. But anyway, that was like the darker days. Loved being a firefighter, but I was a financial illiterate. And in truth, my house was in pre-foreclosure in 2007. And we all know what happened in 2008.
Yep.
But at that period of time, I was praying to my God, screaming and shouting and crying a little bit like, hey, I've done everything the way I'm supposed to. I don't lie, cheat, or steal. I'm a good guy, I think. What the hell's going on? This American dream's a freaking American nightmare. And, I'm praying a little bit. And Teach Me Foreclosure, a free 1.5 hour seminar coming to your neck of the woods was an ad on the radio. And I'm like, okay. And that's where it started, brother. I'm a product of that no money down seminar world. And, I went after it with a vengeance and never looked back through my years as a single family flipper and doing wholesale transactions. I took to it like a duck to water, but I was passionate about it. And I was also very driven. So, those things help.
So you started in the more or less the quintessential wholesaling, flipping, kind of like the hardest work within real estate, right? It's a grind in all ways. You're actually lifting hammers, dealing with subcontractors, materials. You're at Home Depot every day.
Yeah, Home Cheapo, baby.
In my days, I was there. They get to know you, by the project name. That's when you know that you've become an actual flipper, is that they know your name and project.
So good.
Yeah. So, but so
my favorite
journey. Yeah, go ahead.
My favorite story.
Yeah, please, please.
You talk about the Home Cheapo, right? There's two of them. There's Home Cheapo and Slows, I call them. And just the epitome of it is, hey, Mrs. Jones, where's your husband? I don't know. He went to the Home Depot 3 months ago. I haven't seen him since. You know what I mean? Or you've gone to the Home Depot 5 times in one day for the same thing.
Well, that too. I have one complaint about Home Depot. It's built for consumers, not not flippers, because if you
Correct.
want a hammer, it should be next to the nails, or the nails should be next to the hammer.
Yeah.
It's the amount of time wasted trying to find the like compatible tool or need of materials. Oh, that
It's like the IKEA. It's like the
It's
IKEA
unreal.
of home improvement. You got to walk down 500 miserable aisles to look for that one nut or screw that you need to finish the project. No, I get it.
Yeah. So, cool. So after that journey, you then got into something else. So what are you doing today?
Yeah. Look, I'm running today. I run a private equity company. We raise investor capital, and we deploy that capital on large apartment complexes in the commercial real estate world. And to back it up a little bit, going into COVID, late 2019, early 20, I've always been involved in all aspects of real estate throughout my career. I mean, I look back now, I've been in this game for almost 15 years. And, I've been a private lender, a hard money lender. I've always been intrigued by the capital side of our business. And I teamed up with some guys from California, and we had launched a hard money lending company, or asset-based lending, as we like to call it, so it doesn't sound cheesy. But, it was a great business model. I was working off of a $50 million line of credit. Because of my time on the TV show and the exposure I got nationally, I had a really strong database of great house renovators who could use this capital. So it was a really good win-win between the team that we put
Which,
together.
by the way, is so hard to find. I have one team that I lend to for all my clients, and I've gone through at least 7 or 8, most of which were just not able to execute. So
there's so many. Look, Tom, I guess, we're in this business 24/7. So, our exposure is real estate. But the amount of amateurs in our business compared to professionals in it, it's destructive.
It is.
It's destructive because, I go back to my house flipping days and I think to myself, how many times did I have to overcome the objection of, oh, you're one of those no money down guys, whether you got the BS from the egotistical realtor or you got it from the seller. And I'd have to consistently say to them, I am not a cartoon character of a caveman. Yeah. I am a professional. How can I help you?
Right.
So don't get me started on that one. But anyway, the hard money lending business, the model was write the loan, and then the loan had takeout partners on Wall Street that were buying our non-QM loans, and that's where it failed with COVID. We had about 18 million in the pipe, and Wall Street said no, thank you. We're done buying these during this COVID transition, if you will. So that put me out of business literally in 3 days. So look, man, I step back, you look at the landscape as a professional in this business, and you say, what was the fault in my business model? What mistakes did I make? And I very quickly came to the conclusion that it was controlling the capital was the biggest mistake I had in that scenario. There are a lot of hard money lenders out there who don't control their own capital. They just get in the middle of a transaction and make a couple of, bips or points on a spread. So I connected with my now business partner, a gentleman by the name of Walter Novicki. Walter's my age, early 50s. He's down in the Florida market. He's been down there for over 25 years. And he and I got on a Zoom call and we're like, hey, brother, what are you doing? Right? Your network is your net worth. And I know that sounds cheesy, but it's a reality. And he said, look, man, he said, COVID is going to create an opportunity down here in the Southwest region, the Gulf Coast region of Florida. He said, which he believes to be unprecedented. Now, you got to remember, Walter has been through 1, 2, 3, 4 cycles.
Yeah.
Right?
Yeah,
he's been through that. I've been through 2 myself.
Yep.
So we've got the scars.
I got 1, so I'll catch up.
Look, you carry him. Stay with me, my Padawan.
I'll catch up.
You too. You're right. As long as you live long enough, you can go through many, many cycles.
Yeah. Can't wait.
And he said, but here's the thing, right? You say can't wait. You say that with genuine intent, because
I really do. Yeah. No,
it's the market cycle changes where the wealth is created for the intelligent investors.
100%.
So Walter said to me, he said, look, man, the mom and pop multifamily investors down here, 20 to 150 doors, they're going to be brutalized. They don't have reserves. They don't have skills. They don't have property management. He said, we can syndicate and buy 1 or 2 of them. He said, or raise the equity capital, 100 million is what we put out there. He said, and we can buy them all. And, that's when the firefighter steps up and the ego steps up. I was like, let's buy them all. So that's what we're doing today. We're consistently raising capital for our fund. So think of it like a mutual fund,
Right.
where you've got mutual properties sitting inside the fund structure and investors can come in. But we also syndicate sidecar deals as well. So that's
So
what we're doing only in Florida.
Is it all for the investors? I mean, obviously, I assume you have a variety of different types of investors, but for the broad market that you would be marketing to, is this all debt? Is it a mixture of equity debt? How's it all structured?
Yeah, great question. So we market to accredited investors.
Yep.
The structure that we put together is what's called a 506C Reg D fund, which allows you and I to talk about this in an open forum.
That's right. So for all you out there, accredited investor, unless it's changed recently, you make $250,000 a year or have a net worth of $1 million.
Yeah, 50% there. Individual 200,000 a year, family unit 300,000 a year, or $1 million in net worth, not including primary residence or equity in a primary residence. And that's, you think about that number, and my firefighter days would go, oh, that's a lot of money, but it's not. $1 million in net worth includes retirement accounts, includes stock accounts, includes.
I actually think I think it's the right number. And I believe, I think for 506B, maybe not a C, you can have up to 35 non-accredited investors.
Yeah, that you can do it. That's a Reg A. You can do a Reg A fund, which will allow non-accredited investors in. But as you said, a 506B, again, I think we're right in saying that does allow some non-accredited in. The challenge is this, this from your career. Yeah. He or she who puts in the least amount of money into a deal makes the most amount of noise.
Oh yeah.
The customer service component of a non-accredited investor, and I don't mean it in any disrespects to anybody.
Oh sure, yeah.
You got to bring them up the gradient. You got to educate first. I've turned away money because the investor is uneducated. I'm more interested in a good alliance.
I have a smaller, I guess, asset-backed lending business, as you call it. And what I have found, and what I do every quarter is I do these surveys and I say, what could I improve on? And a lot of it comes down to transparency. So now I have a team, and my team creates these reports every month on the status of their projects, when it's estimated to close. We have a risk score analysis and everything else in between. And I think that level of transparency really gives the model to these, newer investors that comfort that they're seeking. Because, at the end of the day, the team and trust is by far the most important part of this business.
Well, that's who do you really invest with? Sticks and bricks or sticks and bricks, right?
Right.
So, investing with a team is the critical piece. And look, that was a big part of why we embarked upon this project. Was we were going to take the notoriety or the celebrity component of the guy from the TV show and bring that to the retail investor. We also brought on a real good friend of mine, Kevin Harrington, one of the original sharks from Shark Tank, for the business development and expansion of the company. And, that helps, but that isn't it, right? Yeah. Just because it's, that guy from TV, it doesn't mean, so, having that track record. And then what we did very early on was we looked at a lot of what our competitors were doing, both in syndicated assets as well as fund structure. And the compensatory packages that investors look at came through what's called a waterfall system. Mm-hmm. And we started looking at the waterfalls of splits of debt and equity. You asked me, how does an investor get compensated? Well, we always compensate both debt and equity. So they come in with a rate of return, a preferred rate of return in our investments. And then they go into a revenue share with us as the GP or the general partners in the deal, because we do all the work and they're passive. And I started looking at some of my competition, and they were so highfalutin, and 20% of the first 40% gets you 5% of the next 6%. And I'm like, my heavens.
Yeah, that's the thing. My models now are simple. I do a basic preferred return of 6% distributed quarterly. By the way, my projects, I'm front loading those for 12 months. Those funds that are giving out, when I request capital, I'm bringing in that amount as a reserve to be able to pay it for 12 months. Yeah, which is really not to my advantage, but I want to guarantee those cash flows.
No, look, here's what we are. At the end of the day, we have one job, and that is to be the steward of our investors' capital.
100%.
If these guys that are out there flying around in jets and driving Rolls Royces, I'm sorry, man.
There's one guy. What's his name? Something.
I don't know. We're not going to mention any names.
Capone.
Yeah, Capone. Um, you know, that kind of imagery creates and attracts, I don't know, a certain kind of investor that, to be very frank with you, is not in alliance with our business model. You know, my avatar is the doctor, the attorney, the business owner, the chiropractor, you know, the engineer who is deep into their business and cannot find these institutional quality investments. I want one I want one intelligent conversation with them, find out what their level of understanding is about these alternative investments. If I need to educate them first, I will, and then we bring in their capital.
You know, it's funny. I would say of all my clients, again, figure in the air, but 85% plus are engineers, doctors, lawyers.
Yeah.
It's those types.
Real interesting. I'll make the story short. Skincare doctor, New York City, Fifth Avenue, right? Sells his skin cream care line, you know, is pump in a bottle, sells it to a private equity company for $65 million, right? It was valued at 90, COVID hit, so he took a haircut to 65 million.
And by the way, it's all brand. It's all brand.
Right. And I said to him, I said, Doc, where's the money sitting? He said, in the bank.
Oh my
I go, what? He goes, in the bank. I go, why? He goes, where else am I going to put it? He said, no, actually, he said, I just authorized, this hurts so bad. He said, I just authorized my money manager to put some of it into the bond market.
Oh my goodness.
Like, oh, so you want to kill capital? What do you mean? And they get all defensive.
It's, you know, it's amazing. I have a friend too, and I won't name his name. He was at Snowflake, worked from nothing, ground up, grinded his way for years, ended up pocketing about 12 to 15 million. And he has a money manager too. And it's hard to even get a hold of them. And it's like, you know, and it's just sitting there, like the cash and these very, so, which actually is a good segue. But before we get there, I do want to talk about what is your structure of returns typically on these projects?
Sure. So we put a fund together, $100 million fund. I, like you, give my investors a 6% pref. So the first 6% of all profits is theirs. And then we go into a beautifully clean and simple 75-25 split. 75% of all profit over that 6% is for the investors, 25% is for us. So if I am incapable, if I am inadequate at my job, I don't get paid, right? And then we do in the fund structure, we do a 72-month hold. And at the point of disposition and execution, exiting out of the investment, again, on the back end, a 75-25 split. So our targeted returns, or our PPM, projects 10 to 12% quarterly distributions on the cash flow, and 1.9, 2.2 multiple, or that kind of flushes out to an 18 to a 22% IRR, internal rate of return on the capital. That's in the fund. Then outside of the fund, if we find deals, which we are finding, that do not fit the buy box of the PPM for the fund, then we pretty much do those on a case-by-case basis. But again, very similar. The waterfalls are very similar. 6 or 8% pref, depending on the deal. 12, 10 to 12 to 14% if it's more of a value add. It might be a little bit higher. But the IRRs are fleshing out at around 2. At around 20%, sorry, and the multiples, we were always shooting for a 2, but you might have a shorter hold period on a one-off deal. So
and I would say those are, I mean, I think back in like 2016, 2017, those would be the norm rates. Today, I'm seeing returns contract down to the 8, 9%, you know, so that with the multiple two, you're looking at 16 to 18%.
Here's why. Here's why we're able to target out like that.
Go ahead.
And it kind of takes our conversation back into a circular premise. Who are you investing with? You will find there are a lot of syndicators that have all of a sudden popped up. Go online right now and Google syndication, and you're going to see 20 men and women all show up and tell you why they're the best thing since sliced bread.
That's right.
Deal quality is everything. Well, why are we able to put those kind of targets out there? Because of the quality of deals that we get. Well, why are we getting them? Because we've been there for over 25 years doing the business. So that motivated seller, just like our old days of a single family, that motivated seller, that mom and pop organization, that pre-foreclosure, that inherited asset, we're one of the first ones. We get calls to go look at assets from Pensacola all the way down to the Keys.
This is really important, actually. Because we have, again, I develop land in Arizona, and what we develop, we have a connection, and we're a smaller player, and we're having to prove our worth, and it'll take time, and eventually we'll get to what you're talking about. And this matters because if you have that brand recognition that you have, anyone who is the first access to the deal knows they can rely on you for the capital, for the ease of execution, and across the board. They don't want to deal with a newbie in the market, right? So there's more volatility, there's inexperience. You're a player that's been there for a long time. You have proven success. So across the board, you're going to get access to the best deals. And what that means for investors, in theory, is lower risk. For sure.
Risk exposure is always an interesting conversation, right? In truth, the very brand new investor who finds their first 75 unit complex could very well have a home run, right? On paper and in underwriting and analysis, it's a home run. But the concerned investor says, well, I don't know if I want to be the first one in. Yeah. Oh, that keeps me up at night. So it's not necessarily the challenge in that aspect. It's a case of being able to look at the overall execution. I say to my investors all the time, every single deal that we do has its own unique business plan attached to it.
Yep.
Do you have the construction verticals in place to execute on deferred maintenance? And the number one, the number one is, what is your property management exception and vertical?
Oh, yeah.
Because it's the property managers that make or break any deal that's out there. So, it's an interesting time. The truth of the matter is that the more educated your investor pool is, the more proficient the whole process is going to be, right?
Yeah.
Because they ask the right questions.
Yeah.
Their expectations.
On that point, when he speaks of education, he doesn't mean what's your degree. He means, what is your experience in real estate? How many deals have you done? How many teams have you worked with? How long have you been doing this? And especially in some of these more complex deals, you do need to know the questions to be asking. And you really only learn that if you work with teams like yours or mine, who will coach you through the process, or you've done it a number of times.
I did a fantastic call the other day. It was, I was actually down at a mastermind in Florida, and I took an investor call that my team teed up to me. And it was a gentleman who's a professional jockey of all people, right? Professional jockey. And super, super cool guy. Like, no airs and graces.
4'6", 85 pounds.
Yeah. And, I quickly did a dive on the man, and, 6 million in earnings last year. Amazing. Serious. He's a player. He's a real rider. But what excited me more than anything else was he's already in 7 syndicated deals.
Wow. He's smart.
With other operators. And, that's the ultimate avatar. That's a guy who says, yeah, take my million, take my $500,000, work it in the asset. If I can jump in on a call every now and again and, get a feel for what's going on, great. Yeah. If I can't, that's okay. Because I got to go ride this monster of a horse this weekend and try and make a living. So, that's education. It's on both sides, not only us as operators, but also the investors, and bringing them up to speed with what the process is.
Awesome. Great. So that's great content and knowledge for any of you listeners out there to get your feet wet and learn as much as you can, and ask questions too. So let's end this on one last topic, and we've kind of hit on it. I think most people know now the prices are skyrocketing across all single families, making it really hard for the newer investor to buy turnkeys at cash flow, appropriately. And, there's other ways to invest outside the stock market or some crazy cryptocurrency. So let's not talk about that piece, but, if you were someone who maybe had, I don't know, $250,000 in capital right now, where would you put it within real estate?
That's a great question. Look, first question I asked, you got $250,000 in capital. Where do you want to put it? The next question is how hard do you want to work the money, right?
Great question.
How much of your time do you want tied up in the movement of that money? So the first question is passive or active. Active investor, it's a job. That's what I do, right? That's what you do. So 9 times out of 10, people believe they want to be active investors. Then when they learn the true process and the amount of work and the amount of exposure and risk that's involved,
100%.
right? They do a double take, and then they say, well, okay, who can I work that capital with? So I got $250,000. I can lend it. I can secure it against a buy, fix, and flip. The single family market is redonkulous right now. The ability to find a good deal is a huge challenge. I could put that capital down and be a landlord. Well, that's kind of a lot of work. Or you can do what we're talking about here, is be a passive investor. So the question I would ask that investor is one, are you accredited? And two, what's your expectation of a return in comparison to what you've seen in the past?
Yep.
If they come out and they go, I want 20% of my money. Well, you're probably not realistic. Okay. Unless you want to deal drugs, that's always an option, but that has a certain amount of risk exposure to it as well. So, if we get mature and we bring some intelligence to the conversation, securing real estate, securing capital in commercial real estate has and will always be the best bet as far as I'm concerned. And I compare what we do in the multifamily arena to the other commercial real estate assets: retail, office space, light industrial, hospitality. And if we look at those other classes right now, God bless them, they've taken a beating. The only other asset class in commercial I would consider, if it was my personal capital, would be self-storage. But again, finding the correct operators.
Yep.
So what's the advantage? Well, there's so many. Let's talk about sticks and bricks, tangible assets. Let's talk about capital working with velocity, because those 8 to 14% quarterly distributions are consistent in our industry, right? They're consistent in our industry with the right operators. And then when we start getting into the tax advantages,
I love the tax advantages.
Cost segregation is such a beautiful thing.
It's it's to me it's poetry. It really is. I absolutely love tax strategy, and I tell my clients, if you're a high earner and you don't have a tax advisor that's powerful in real estate, you're not doing it right.
Yeah, for sure. For sure. And look, again, it's asking questions.
That's
Time
right.
is exposure.
Yep.
A guy said to me early in my career, he said to me, show me who somebody gets their financial advice from, and I'll show you what their financial future looks like.
No, that's great.
And for me, it was like a dagger right in the heart, because it was like, all my financial advice came from blue collar working class influences, So look, the tax world for that 250, I'm not an accountant, I'm not an attorney, I'm not giving anybody any financial legal advice, but I can share with you on this call that I have seen K1 distributions that have been a 100% write-off against tax.
Yeah.
Right. So what would it be like if you could put in 250, get 125 or 200 in profit and not pay any taxes on it?
Exactly. Yep.
Would that be a conversation worth happening?
Yep.
I think the answer to that is a big fat stonking yes, when you think about how much time people are spending out there trying to earn money. So look, commercial real estate, there is no other better tax advantage than commercial real estate, with the fact of hedging the downside. Yeah. You start talking about leverage of that 250, that 250 in essence massive. Can buy $750,000 worth of real estate. Right.
Yeah. Yes. I mean, so not to get too granular here, but ever since the bonus appreciation and cost seg came out, before that, it was really oil infrastructure was where that was where the big tax savings were, a lot of risk. But now essentially 1-for-1 real estate has the cash flow advantages, the long-term wealth accumulation. I mean, there's so much more to benefit with real estate now versus any other tax shield out there.
Would you agree with me in saying that the lineage of tax advantages in real estate is a lot simpler than some of the other strategies? Like sometimes you got to get so deep into it.
I think we all know what a house is. We know what's behind the walls, right? Yeah. If you think about energy and oil, we have no idea what goes into that, right? Or mining or whatever you're putting, or farming. We don't know anything about that. So it's hard for us to grasp those concepts. Real estate could be complex, but we generally know what it is as people.
Right.
So.
Right. So that's where I'm putting my 250. I think that's where you're going to put yours, and whoever that other guy or girl is, we can do the same for them as we do for ourselves.
Yeah, exactly. Right? Dave, this has been awesome. If people want to get a hold of you, and by the way, all this information I'll put in the description below, where can they find you?
Yeah, I'm old school, man. I'm attainable. You can actually pick up a phone and get a hold of me. Call me at 781-922-4418, 781-922-4418.
You know, I love
Just
this is the first podcast I've done where someone has given their number.
yeah. Just let my assistant know that you heard us on Tom's show, so that I can track where you came from. Info@freedomventure.com. Google Dave Seymour. I make a lot of noise on the internet. It's all part of our business.
That's right.
To be available. So yeah, if you want to find me, you can find me for sure.
Fantastic. Dave, it's been great.
Appreciate you, man. Thank you.
Thank you.